In May, uniformly positive economic fundamentals turned mixed over fears of a two-front trade war. So, the Federal Reserve abruptly reversed its policy on interest rates, and it propelled a rally in stocks this past week. Amid all the crosscurrents, here are the facts. The yield curve inverted on May 14th, and because inversions have preceded every recession since 1954, it made investors nervous. The yield curve is the difference between the rate at which the Fed lends to banks and the rate on the 10-year U.S. Treasury bond. The Fed lends money to banks at the 3-month T-bill rate, and banks lend it to businesses at a higher, longer-term rate. The inversion destroys a bank's incentive to lend, which causes a decline in economic activity. Looking at the current inversion, the 3-month Treasury bill was recently yielding 2.33% versus 2.1% yield on a 10-year Treasury bond. A sharp rise in short-term rates concurrent with a decline in long-term rates caused the inversion. Just 6 months earlier, the yield curve was steep, with the 3-month T-bill rate at 1.39 versus the 10-year rate of 2.47. The last yield curve inversion occurred in March 2007 and was followed by the Great Recession of 2008. Not every yield curve inversion causes a recession. For example, in June 1998, the inversion was met with a reversal in Fed policy, and the economic expansion continued for nearly another 3 years. And that could happen again. In a June 4th speech, the chair of the Fed, Jerome Powell, indicated the Fed was changing its interest rate policy. Following a breakdown in U.S.-China trade talks and an announcement by President Trump of a plan to tax imports from Mexico, the Fed's reversal reassured markets. Barely a month has passed since the Fed said that it was holding rates steady and did not expect to ease. The Fed's abrupt reversal came after weakening in some key signals. The Atlanta Federal Reserve's real-time model for forecasting the current rate of growth of the economy plunged. From a 3.1% growth rate in the first quarter of 2019, the GDP Now forecast for the second quarter was just 1.5% as of June 6th, a sharp deceleration in growth. Then, on June 7th, the Labor Department said the economy added 75,000 new jobs, less than half than the 180,000 expected, though unemployment in May remained at a low last seen in December 1969. May's weak new jobs estimate from the Labor Department was corroborated by a monthly estimate of new job formation by ADP. And another sign of weakness came from the Institute of Supply Managers Index of Purchasing Activity, which ticked down to 52.1 from April. But not all signals have been weak. The ISM Index of Purchasing Activity at non-manufacturing companies ticked up in May to 56.9. Since non-manufacturing accounts for about 88% of U.S. economic activity, that was good news. With fears of a tariff on imports from Mexico easing, the Standard & Poor's 500 index gained 1.1% last week. Stocks were just 3% off their all-time high of April 30th. The economy has been expanding for 119 consecutive months and is within days of becoming the longest expansion in modern U.S. history. Despite the U.S. leading economic indicators ticking higher recently, the 50-year low in the unemployment rate, benign inflation, and surging productivity, uncertainty is also high and stock price volatility should be expected.